Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest SPI data, the Selected Prices Index, out from Stats NZ, covering around 44% of the inflation basket on a month-by-month basis. Some interesting trends starting to come through there. Of course, I've been looking most closely at the Food Price Index, up 2.1% over the last year. That's actually the slowest it's been since, I think, mid-2021. You saw fruit and vegetable prices, for example, actually falling down 9.3% on last year. Part of that's because last February you had the likes of Cyclone Gabriel that came through, wiped out a bunch of supply, and that pushed prices higher. But again, some moderation, some better trends in some areas when it comes to consumer prices, like I say, food in a better direction. You've had a look at some of the others, a bit of a mixed bag though for some of those other indicators, the other prices that Stats NZ measures.
Yeah, we've seen renewed lifts in fuel prices coming through in February, both across petrol and diesel. So that's a little bit of a reversal from the trend that we had been seeing in previous months. Airfares also up. Domestic airfares up almost 8% from where they were last year. International airfares still down from a year ago, but only by 2.8%, which isn't very much when you look at the previous 4 or 5 months. So we're anywhere between 15 and 32% lower than where they had been a year earlier. So there's certainly a bit of a lift going on through there. Hard to know whether it's temporary or something a bit more permanent. One of the other interesting big movers was overseas accommodation, which you wouldn't think comes into the CPI, but if you're buying it in New Zealand before you head overseas, Stats NZ do count that, and that was up a massive 25% from a year ago. A bit of speculation around the traps that maybe it was something to do with a certain Taylor Swift doing concerts over in Australia, and therefore accommodation costs surrounding those significantly higher than they might otherwise have been. We'll have to wait until March, I think, to see what the numbers look like coming through there, to see whether there's any validity to that argument. But yeah, just some numbers coming through there which make you a little bit uncomfortable about how inflation might be going and where it's going to be heading to from here.
And of course, when the Reserve Bank is telling us you need to calm down, and those prices continue to go up in some areas, it makes it a little bit more difficult. And I think as well, you look through some of those figures, again, not necessarily the most massive components of household spending, but some of them are large enough gains, the likes of that overseas accommodation, for example, to actually make a bit of an influence potentially on the headline inflation rate. And again, I think probably a bit of a challenge for households where they are seeing that more mixed bag, the likes of food prices, which are a lot more volatile. At least they're into a better position than they've sort of been over the last year. Of course, households still not going to be comfortable, though, with the fact that rents continue to increase as well, up, I think, 4.5% on average over the last year. And of course, in some parts of the country, particularly Auckland, those high migration levels have been pushing them up even greater. I mean, when we're looking through all of this, again, sounds like a little bit of probably a more negative view, or a bit more pricing pressure than we might have been anticipating coming through. I mean, what does that do in the Reserve Bank's estimation? They'll be looking through those figures. They've said previously, and I'm sort of paraphrasing in my own way, that they had a plan. The plan was working. They wanted to stick with the plan. Is the plan still working on these numbers, or are they going to be starting to feel a little bit more worried about how much pressure's in the system?
Yeah, the risk is that the headline inflation number next quarter comes in higher than the Reserve Bank had been picking, and I think higher than probably most other forecasters, including ourselves, had been thinking as well. We're now looking at headline inflation sitting at 4.4%. That's equivalent to a 1% quarterly increase. So it does suggest that maybe that pace of moderation that we'd seen over the previous 6 months or so in terms of headline inflation, not quite as fast as it had been. Now, it's a little bit hard to sort of know how the Reserve Bank will react to that, given we don't really have a good steer at the moment on how much of it is tradable based and sort of outside the Reserve Bank's real sphere of influence. And also we know that, of course, tradable inflation had been moderating more quickly than we had been thinking previously, so maybe it's just a bit of a reversal out of that. How much of it is non-tradable inflation lingering in the system, continuing to stick around, and that's the stuff the Reserve Bank will be most concerned about. Non-tradable inflation was still sitting up at 5.9%. 2% in the last quarter, well above that headline rate. And so the Reserve Bank will be wanting that to continue to moderate. And if it doesn't, then there are risks, I think, that the Reserve Bank, well, it'll be reiterating, we know, the message of interest rates staying higher for longer. I don't think there'll be enough there to necessarily push them towards another raise. They were sort of leaning away from that at their most recent statement. But yes, certainly financial markets, I think the last time I looked, they were still pricing in 2 interest rate cuts this year. That is quite counter to what the Reserve Bank had been talking about. And if inflation doesn't play ball, then things will move back more towards the Reserve Bank's trajectory for the OCR, where it's not till 2025 where you start to see those cuts coming through.
Yeah, absolutely. And I mean, the Reserve Bank's also said before that although things are getting in the right direction, they had sort of little tolerance for a lot of upside risk. So again, if we're sort of talking about maybe a 1% quarterly jump, I've seen other forecasters sort of in the 0.6, 0.8 area. I think the Reserve Bank was forecasting 0.4. So again, the numbers would be quite different if they came out at that larger level. And there's that question then over, how much should the Reserve Bank be looking at or needing to target headline versus say non-tradable inflation. If it is Taylor Swift, for example, that's been changing those numbers around in terms of international and overseas accommodation, is that the sort of thing that it tells us a lot about our current inflationary trends, or is it a bit more around the measurement that comes through? I mean, we'll continue to assess not only the rest of the data when we get the next amount of or set of SPI data out for the March month, and then of course inflation itself, and importantly what that means for the Reserve Bank and interest rates. Can they cut still this year, or maybe are they starting to push it out into 2025? Are we continuing along that inflation fighting path, or are we sort of fighting or finding a few deviations in the mix? We'll do all of that on one of our future editions of Econ Talks.